Frank Holmes, there hasn't been an airline ETF since the last one was grounded 2 years ago, but now your JETS, the Jets ETF, is taking flight. How'd you do it?
How do I do it? Well, I'm flying so much and so often, 100 times each year, I started to recognize the airline industry pricing power was going up and bought some Alaska Air and said, you know what, there's no ETF around, and I've seen the mutual fund business switching over to ETFs, and I wanted something that had a smart beta, a discipline, and I wanted something where no one else was around, and it was available. So I started constructing the ETF with key factors like cash flow return on invested capital, net profit margins, et cetera, to screen these stocks, and came up with this particular index.
All right, we'll talk about what stocks are in it, because it's not just airlines, it's not just domestic airlines.
Well, it's 80-20, 80% domestic and 20% foreign. The foreign holdings are capped at 1% each. So we take from a universe of about 83 names and we distill them down to 20 names, but they have to meet these fundamental factors to qualify each quarter. So in those 20 names, there's a few airports because you can buy airports. Macquarie last year was up 60% as an airport. And so these are attractive investments, and they have a low vol compared to the Jets, because Jets as a whole have a running 20-day volatility of plus or minus 7% like biotechnology. So then we turned around and looked at the domestic airlines, and about close to 70% are airlines in America, dominated by Southwest, United, American, and Delta.
All right. Now, who is this ETF for? Is it for traders or individual investors? Because there are other transport ETFs out there, but they own a lot of trucks and railroads as well.
Yeah, trains and trucks and planes. And ours is focused on a niche that's the least expensive. It's interesting to observe that trains and trucks trade at 19 times earnings, and this category trades at 9 times. It's a fundamental GARP investor. It's attractive. And then for the hedge fund manager, it's been very attractive. They've asked for a product which did not get confused with trains and trucks.
But have investors perhaps missed their flights? Because it's been very hard to make money in airlines historically. But now they've been taking off because of lower oil prices. So maybe are we at the top now?
No, it's not just low oil prices. What's important is to look at 70% were in bankruptcy proceedings, 2011, 12, and 13. At the end of 13, that was all behind them. What did they do? They cut 30% of the flights. They increased the fees. One thing they did that was very positive was that they improved lost luggage. So a 60% drop in lost luggage because they put more money into technology. And with that, you saw these airlines are already taking off at $100 oil. Most of them hedge 50% of their costs out every month. They're rolling it out. So it's interesting that even though oil fell, it didn't have the big impact. These things were doubling and tripling before oil fell.
All right. Well, good luck with the new ETF. Thanks a lot, Frank Holmes.
Well, thanks to be here.
Thank you for watching The Street.